I'm extremely honored and super happy to moderate this matter with the founder and CEO of Blockstream, father of the proof of work, Cash, Adam Beck, and Marco Argentieri, the founder and CEO of Arc Labs. So today we want to talk about the layer 2 on lending and borrowing and how this can enhance opportunities like doing lending and borrowing on Bitcoin and beyond. So, well, thanks Adam and Marco for coming. First question to you, Adam. Let's start with, for those less familiar with, with the layer 2, could you maybe explain a little bit what Liquid Network is for a non-technical audience? And yeah, we will get started with that, and then very similar question to Marco for Arc Labs, so we can set the scene.
Yeah, so, well, Blockstream was actually started in 2014 to build a new type of layer 2 called a sidechain, and Liquid is the instance of that. So by, I think, 2015, we had the open source first release, and 2018, we had the Liquid network running live, and it's been through kind of multiple upgrades since then. And so Liquid is a sidechain of Bitcoin. That means that it's a chain where the native asset is borrowed from the parent chain, and the parent chain obviously is Bitcoin, so that means the native asset on Liquid is Bitcoin, and you're generally paying fees in Bitcoin. Of course, you don't have to. You can use Liquid Taxi, which is something that Marco developed some years ago, and more recently you can actually pay fees in a few designated currencies like Tether as well. And so it's a slightly different security model to Bitcoin, which is sort of necessitated by the technology limits of the era, and gradually those are, maybe becoming more flexible and improving over time. But it's a federated model, so there are a collection of businesses that are members of the Liquid membership, and a subset of them are running hardware security modules, which are signing Liquid blocks to say that it's time to move to the next block. So it's the federation members are making a 2/3 signing, so at least 2 out of 3 have to sign for it to be valid, and that is the alternative to mining in this network. And then there is a peg mechanism where you can move Bitcoin in and out of it, and then because it's a sidechain, you can introduce new features. So it has the native support for issued assets, so stablecoins, bonds, and actually securities with a kind of multi-sig model called asset management platform, and also confidential transactions, some additional opcodes for scripting, and since July this year, actually, Simplicity is also live on Liquid, which is a much more ambitious long-term project, sort of intended for Bitcoin ultimately, but Liquid, because Liquid's very Bitcoin-like, we could deploy it more quickly, and so people have been able to build Liquid smart contracts using Simplicity as an option as well now. So it's just a soft forkable, additional sort of next-generation smart contracting language designed for Bitcoin UTXO-like model. So that's what Liquid is, and it today has, I think, over 70 members, different startups and exchanges, who are participating, building products on it, building wallets, explorers, all kinds of things like that, and issuing assets, and it has about a little over 4 billion of assets issued on it from different issuers.
So not only a layer, also an ecosystem. And so Marco, about Arc Labs and Arcades, well, first of all, congratulations for announcing the kickoff of the live of Arcades on Tuesday this week. Give us a brief overview, please.
First of all, thank you so much. I'm humbled and honored to be sitting with Adam, even though we've been working together. I've been working on Liquid for the past 5 years, but I'm very, very happy to be here. So thank you so much for the invite. Yeah, I think Arc and Arcade, which is the name of our commercial platform that is using Arc protocol, in the end is not a blockchain, is not a channel-based. I would say it's a completely different approach, and I will describe it as a transaction batching. So we all know that Bitcoin itself is limited by block space and block time. We have 10 minutes block, we have limited amount of transaction that we can put in a block, and the idea is how we can have virtual transaction that can be compressed in a single Bitcoin transaction, and this is like what we can consider true horizontal scaling, because doesn't matter how many users we bring on board, it will always consume one single Bitcoin transaction. On top of that, there is more to that on how you can basically send transaction between batches. So the trust security model goes from a full Bitcoin finality, which inherits entirely the security of Bitcoin. But then if we want instant transaction, we can have a model which is more similar to the state chain approach, which means that you can send instantly your transaction in a virtual mempool, and which means you can create more advanced contract in the Bitcoin blockchain without waiting for the next block. You still execute your contract of chain in the virtual mempool, and then you will decide to consolidate and batch and get full Bitcoin security. We launched a Tuesday at public beta, so we are live on mainnet on Bitcoin, and Arcade is the name of our platform. An interesting aspect is a more like client-server model, right? So it's not really a blockchain, it's not a distributed system, but really allows to delegate to a set of operators all the complexity of liquidity and management, and then have the user with a very easy user experience, and which translate easier integration for developers, startups, and users in the end.
Thank you, Marco. So now let's connect this to something very tangible to our audience, and talking about Bitcoin as collateral. So Adam, how can Liquid be used for lending and settlement between counterparties, and what makes it more suitable for institutional transactions that's the main Bitcoin network?
Yeah, so because it's a sidechain, and as I mentioned, it has support for issued assets, one of the larger assets on there is Tether itself, I think around $100 million and growing. And the point there is that most loans at least in the sort of Bitcoin native space, are actually made using stablecoins. And for the HODL HODL platform, they have a lending subsite, which Liquid Tether is the sort of more popular stablecoin to borrow. And you can use main chain Bitcoin as collateral, or you can use Liquid Bitcoin as collateral. Now, in principle, the advantage of Liquid Bitcoin as collateral is you can make a more elaborate smart contract that governs the behavior of the loan. So, you know, there have been some covenant-based smart contracts that have a way to, you know, require an interest payment, to have, you know, some kind of ability to defer an interest payment, and if you defer it too much, then you're in default, and there's a kind of whole kind of loan servicing logic built into the contract. Whereas with the Bitcoin collateralized loan, that loan servicing logic is more sort of mediated by the platform. So HODL HODL or Unchained Capital, and there are multiple platforms that work with this kind of collaborative custody of the collateral, so like a 2 of 3 escrow. So those are the trade-offs, and of course the simpler loans don't actually pay interest. They just do PIK interest, which means they compound the interest, and then you have to pay it at the end when you close the loan. So sort of simplifies the servicing, particularly for the case where you have to have all of the loan servicing managed by a party that is central but doesn't have like direct custody of the assets. And of course, then there are also custodial platforms that hold the Bitcoin. Signum Bank is one. There are another, you know, and you can use traditional brokerages as well. Of course, if you put the Bitcoin into a Bitcoin ETF, they can use that as collateral. So lots of different models. I think the interesting thing is to reduce the risk.
So agility and security, I guess, in a nutshell. So Marco, from your perspective, so then how does ARC model allow for new types of liquidity or credit instruments without compromising Bitcoin security model?
Yep. So I think in general, like all our team been working on Liquid in the last year. We appreciated a lot the UTXO model, and Liquid, like Bitcoin, use the approach of having data structure that really allow parallel execution, and this is very important. If you think about many other model in other blockchain, we know about many times that when the price of Bitcoin and this, like, let's say, lending protocols, when the price of Bitcoin crashes, you need to liquidate. And this is very big problem, because if you're constrained by block space and block time, again, which means that you're like missing your liquidation, and you're not actually honoring the contract itself. And it's a big problem. So executing this on the layer 1 itself is problematic. Works on a small scale, but if you want to start processing basically, thousands of loans like normal financial ecosystem does, is really not something that Bitcoin base layer can do. So definitely we need to compromise and trying to go on a layer 2. And I think what we are doing with Arcade is also exploring not only just the peer-to-peer lending use case, which I think is very, especially for a Bitcoin borrower, what you expect. You want to see the collateral, you want to see where he is. And most importantly, it doesn't want any rehypothecation. But at the same time, this peer-to-peer model increase the interest rate. In general, like what we can see is very hard for peer-to-peer lending model to have very competitive rates compared to pooled model. And in the end, like what is a bank is a pool, right? So historically, you go get a lot of deposits, small deposit, and then you lend out. And I think a pooled model is what we're very interested to see and what we're trying to replicate with Arcade. And in Arcade, we also announced both Arcade Asset and Arcade Script, which allow you to have more expressivity, which means you can build so-called smart contracts, which allow you to create covenant pool, which will allow definitely to lower the interest rate because the liquidity is more efficient. And most importantly, you can, in a way, try to create a secondary market for that collateral. The liquidation rights could be sold, could be fractionalized, could be shares, so a lender can actually share the risk with other lenders in case of needed liquidity.
Right. So basically, both Arcade and Liquid are building the rails for Bitcoin credit market. So question to the both of you. So what's still missing for large lenders or asset managers to start adopting them?
I guess it's like a trust question, and to build the legal interpretation of how they should look at this form of collateral. The collaborative custody model is quite unusual for a corporate lender. They would probably want to either have a custodian, independent custodian, or have direct lien on the asset or possession of it because it's Bitcoin themselves, just because of the way they would look at other kinds of collateralized lending, right? And then I think the other thing is, the user experience from the corporate lender to manage a list of loans and potentially to resell loans. So I saw Max in the room somewhere. They have another product which is Debify, which is targeting that kind of experience. So I think that's one of the things. And also the institutional custodians that can hold Bitcoin, that have the right licensing, are relatively new. And there may be a space for them to engage in collaborative custody between different custodians. So kind of a multi-sig between custodians, that could be high assurance for the individual lender to say, well, if I have to give up custody, at least I want multiple independent parties involved. So that could be a way to get higher security for Bitcoin than you can get for physical gold in a single custodian, because you can have multiple custodians and need a majority of them to be compromised, where that doesn't work for physical gold.
I think in general, for sure, regulation is one of the biggest issue that we may see when any of this new scheme or this new protocol, they by design they are innovative. They don't exist yet, so they need to be explained. They need to make sure they check the boxes for many of more institutional players to be confident. And I think Adam is very right in the sense that you need to compete with more than 400 of years of trust from a classic banking audience. So it's normal to, at the beginning, to eventually, and that's, I think, what I'm very interested too, is exploring new type of use cases that wouldn't be possible without Bitcoin. And that's why I think combining the Bitcoin lending and try to go to market with new originator platform that can be startup, which have a higher risk appetite, and usually those can take this risk and also pave the way to explain how more institutional investor can adopt.
I think resellability of the loan is a big one, because if you are relying on, banks have to manage liquidity, so typically they would want to be able to, package a loan and then treat the loan as a security that they could sell and resell, and want a liquid market to be able to resell them. I think that also is important for users. Some of the custodial and non-custodial platforms have liquidity markets where you can lend liquidity and then you can't close the liquidity because you've lent it. But if you can sell the loan, you might take a bit of a haircut, but then you'd be more willing to lend more because in a pinch, you could get it back by selling the loan, right? Today, some of the platforms don't have the resellability. So I think those, you could, in something like Liquid or Arc, you could tokenize the loan and transfer the loan, sell the loan. It becomes a
syndication type of.
Yeah, it could become a tokenized security, or of course, like liquidity pool is another approach. But even without liquidity pool, if I've placed a loan that's, receiving 10%, and I want the liquidity quickly because I see some opportunity in the market, maybe I can sell it for a discount, so the buyer gets 12%, and then they're attracted to buy it. Whereas if there's no liquidity and resellability, and it's all locked and bound to the collateral, then I'm going to be hesitant to lend because I won't be able to access liquidity. So I think that the resellability is important for liquidity. Absolutely.
So let's talk about the most loved acronyms that the gods of finance has given us, KYC. So let's talk about the integration of KYC in custodial constraints. So Adam, Liquid has features like confidential transactions that balance privacy and auditability. How do you see that's aligning with institutional compliance requirements?
Interestingly, I was talking to somebody yesterday who said that they were able to get permission to use something from a central bank because of the confidentiality, because the central bank didn't want, public transparency on a conventional blockchain. So it can work to your advantage. And then with Liquid, you have the option to use also AMP, which is an asset management platform. And there you can have a co-signer like Stocker or Bitfinex Securities or any issuer, which is sort of making a security where you have to get onboarded to buy it or to trade it or to sell it. And with that, you get a kind of combination, which is the issuer has visibility. They can share it with their auditor or a regulator of these assets selectively. And yet it's still confidential to the outside world and generally confidential between the three parties, the issuer, the seller and the buyer, or the borrower and the lender. So it's possible to, and the identity of the parties is not visible on the blockchain. It's known by the issuer or the share registration agent. So I think it's a nice and elegant model because once you are onboarded, the experience feels the same as if you were doing it with Bitcoin. It's just the identification information you provide to get onboarded is held by the issuer offline, hopefully in a database, and then they are kind of whitelisting your wallet, your ID, kind of like a unique identifier for your wallet. And once you have that, you can transact freely in that group of assets. So it makes it low friction and easy for, it sort of abstracts the regulatory compliance away from the innovator. So the innovator can build an application on top of it that's compliant without having to deal with all that stuff, because it's been dealt with by the issuer or the onboarder or the share registration agent. So they can write a wallet that has trustless swaps without having to worry about all those details and still end up in a compliant way. So it's quite an interesting model which gives you a nice mixture of confidentiality, privacy, and a way to sell securities in a way that's not, that's complying with local securities rules.
Right, and so Marco, I'll come to you with how our ARC fits into this regulated or semi-regulated environment. So say private banks or credit providers using Bitcoin as working collateral, how would they look like?
The interesting aspect of the ARC protocol is it really lifts the same UTXO and the same Bitcoin model to the virtual layer of chain, which means you can still retain the same transaction, you still retain the same concept down the road on Explorer, which really doesn't change much from the Bitcoin blockchain in terms of auditability and trail on that aspect, because in the end, it's always pre-signed transaction, and these transactions, when revealed, are always easy to be tracked and connected to each another, and very much aligned with what Adam is mentioning, in the sense that all these tools can be built on top and can be offered by other companies or the platform that are going directly to the customer and to the market. But in general, it was also interesting to see how new fintech and new neobanks can actually try to leverage Bitcoin itself to actually create some sort of synthetic asset that actually don't require to have any link to a real asset, but still like trying to track as much as possible a real world asset, and that will also help to create different type of products that can be way more easily integrated with the current wallet.
Fantastic, thanks, Marco. So going towards the end of this panel and chats, if we would meet again here in 2 years and we'll talk about the layers 2 progress, what do you think, what would you hope to see in how institutions can use Bitcoin layers 2, like Liquid and then Arcade?
Yeah, I mean, I think one of the missing things is the availability of institutional custody, because institutions, it depends, if it's a neobank, they are going to, develop or work with a company to provide them with the technology to self-custody or to, hold the keys for the layer 2 securitized loan or something like that, right? But with traditional institutions, they don't hold shares, they hold them via a custodian, and they need that same facility. And typically they would want that to come from the custodian they already have for holding shares. And so there is some, progress in institutional custodians entering the space, and the regulations in the US have become more friendly to enable the existing custody banks to participate. And Blockstream Capital Partners invested in Kamainu, which is another existing institutional custodian that, is holding some government assets and so on. So I think that kind of middle layer is actually important for kind of regulatory access from the established financial institutions. So I hope that we see more uptake in a few years based on the growth of that, and probably the entrance of some large custody banks and maybe some mergers and acquisitions where those kind of custody banks buy a digital custodian because they need to rapidly learn how to do that securely. I
think it's interesting because Bitcoin is one of the best layer and blockchain out there, and we all think that Bitcoin is here to stay and won't go away. But sure, what I'm looking forward is trying, and right now we are seeing, the Stripe of the world going to use different technology than Bitcoin, right? So they're going to build their own blockchain. They're building Tempo. They're building their own separated from Bitcoin. And I think this is just like, because Bitcoin right now doesn't have the infrastructure or never work infrastructure like Liquid and potentially what we're building with Arc, to give to this new institution to actually look at Bitcoin not just as a static money, but more than that. So Bitcoin already fixes, the savings, but sure, Bitcoin can be also the backend for financial institution to actually be the new backend for a new type of financial ecosystem. So I'm really looking forward to see this institution to look at Bitcoin not just by accumulating it, but actually to use it as a platform for them.
Brilliant. So very last question, probably 1 minute each. So especially for those in rooms that are in the industry, risk officers, credit managers, chief investment officers, and so on, what's the first practical step they can take to start learning or experimenting safely with Liquid and Arcade?
Yeah, I mean, I think they should talk to one of the technology companies or somebody in business development, and somebody that's developing the technology to gain an understanding. And I think, as we said, a big part of it is developing the legal framework inside the institution to interact with the technology.
Thank you, Adam.
We are very nascent, so we are not like on the block like 7 years like Liquid, but we're already launching with a couple of interesting startups as well. So I also think that there are here on the stage originator platform already that are experimenting with Bitcoin-backed loans, and in general, I think it's going to be way more easy to see these in the real life as we go forward.
Brilliant. Thank you very much, Marco. Thank you very much, Adam. Yeah, thanks again for joining the panel.